I think there are two big players on equity right now. One is the lack of a Fed put, so the Fed's not going to come in and rescue the market, can't because of inflation, and then geopolitical tail risk, which is now just increased. The good news, of course, is that NATO has strengthened. You're at the G20 conference. There's more discussion between the United States and China. That's all kind of good news. But we still have this huge geopolitical risk, which frankly the equity market just doesn't know how to price in.
Indeed, and we could sort of drill down into much more specific tail risks, and these are related to the ongoing war in Ukraine, and that is the Black Sea grain access deal, right, and also the price cap on Russian oil. Do you think markets have priced the risk that the grain deal may not be extended, one, and two, that the price cap on Russian oil may not work, and therefore we are looking at continued elevated prices for food as well as for energy, which would put central banks in a pretty difficult position?
Martin, no, I don't think either of those have been fully priced into the market. The market, especially the equity market, is probably a bit over optimistic at this point. Again, because of that tail risk, because while inflation indicators are down a little bit, obviously good news. We think the Federal Reserve and other banks are going to continue to raise interest rates, and that pivot, by pivot meaning when interest rates will actually drop, is probably a year, 18 months away at least. Doesn't mean equity markets can't perform, but equity markets have to be careful about getting ahead of themselves. Just a little bit on that. Franklin this week is celebrating its 75th anniversary. I've been here 30 years at Franklin Templeton. During that time, you don't have a group of equity managers that think that the market may not have bottomed. Equity managers, by their nature, are very enthusiastic and positive. We just held a meeting of our CIOs, and they think that possibly the market may not have bottomed. So yes, there's some real serious tail risk out there. And that just means to be cautious in the market. We're still positive about it. We think probably a shift more a little bit to fixed income, more a little bit to income within the equity markets makes a lot of sense.
Okay, Stephen, a quick question for me. This flight to safety you talked about, the shift into income, is this going to keep yields where they are well supported? Because everybody's talking about yields peaking. Is this going to push yields up even further higher? Yeah, we think yields will probably go a little bit higher. The Fed will probably stop around 5% or so. So we haven't seen the peak in yields yet, but we're close to that. And then we think that probably inflation will not fall as fast as perhaps the market thinks, and probably not get down to that 2% level, maybe not for a couple of years. It's fine for markets, both fixed and equity, if we're actually at a 3-4% inflation level, but that means interest rates are not going to go down. Okay, quick one from you. December rate hike. What will it be?
Hard to tell. Fortunately, I'm a strategist, not an economist, but I'd go with what the markets think, 50 basis points.
Okay.